In today's video, you guys are going to be able to identify high probability trades versus low probability trades. You guys are going to be able to identify what supply and demand zone puts the odds in your favor against versus having the odds against you. So let's get right into it. So this video is going to be straight sauce. So I'm gonna give you guys two examples, right? The two main examples. The first example would be, let's just say you're trading New York or you're trading London, and your session gives a big push, creating an area of supply, and then giving a pullback, and then creating another area of supply. So you would have, by definition, the previous contrary candle is your area of supply, right? And you have another area of supply created here. Now, if your session starts, it could be London, New York, whatever session. But if your session starts and you get a push, a pullback, and another push, creating two areas of supply, the higher probability area to take is going to be the one that creates the push. This is just a pullback to continue the push. So this right here is a low probability trade to take. Majority of times, price will do something like this. Price will use these areas just to get a pullback, something like this. We'll get a reaction off of it, but this will just be a pullback into like an area of demand to then continue the push to the true area of supply to give the actual move, something like this. So you'll see, for example, a push, a pullback, and then a push. Price will use that secondary supply created just as an area to get a pullback to actually go to the true area supply to continue the push. So this would be example one. Example one would be like your area. It could be supply or demand. Same thing. It would just be vice versa. So example one would be that your session creates an area of supply or demand, and then you get a push, creates another area of supply, and then the true area of supply, that's your high probability area to take a trade from. That's example one. Now example two, guys, check this out. Example two would be if your previous session does something like this. If your previous session, like pre-New York, or let's just say Frankfurt, if you're trading London, gives a big push, we have a void, and then during your set, like for the rest of the session, we got something like this, and then the next session that you're trading, we create an area of supply, something like this. So if you have something like this, your previous session gives a big push, and then you in your session, you're trading like this is London, you're trading New York. New York is a big push, creating a new area of supply. Same thing. This is just a continuation. Like this is just a pullback. The true area of supply is the one from here. And especially if you have a void to fill. So if you have an area of supply right beneath like a big void with a true area of supply, this is a low probability area to take a sell from. The high probability area to take a sell from is always the previous contrary candle that creates the push. So same thing, you'll get something like this right here, a pullback, and then you'll react off the true area of supply. So this would be example two. Example two would be that the previous session gives a big push, but then your session creates an area of supply right beneath that one. Your session's supply is low probability. You'll just get a reaction off that area, and then price will pull back to the true area of supply to continue the push. So we'll see this live right now. I mean, we'll see it live here as in a breakdown, but we'll break this down with the trade. That actually took in the market. So if you follow me on Instagram and the free Telegram, you guys saw that I took this trade with a sell limit. So we'll break that down, and you'll see a low probability trade versus a high probability trade in the market. So check this out. This was right here Thursday last week, right? So we're trading Tuesday today. I figured I'd do a YouTube video on this because I know some people that actually lost a trade on the low probability setup, and I took the high probability setup. So I was like, you know what? Maybe some people, not maybe, 100% sure that a lot of people could benefit from this video. So pay attention, guys. We'll drop some heat right now. So let's do this. Let's replay to exactly where price was when we came to trade, right? So we come to trade. We go back to the M5 time frame because the first thing I do is mark my highs and lows, right? So if we're trading here on Thursday, the high and low is going to be one previous trading day than the one we're trading from, which would be Wednesday. So real quick, I'll just mark my high and low, which are the lowest and highest points between Frankfurt to New York session. So this is my low of day right here. And then I have my high of day up here. And then now we just need to mark the previous high and previous low of day, right? Which is going to be two previous trading days before. So this right here would be our previous low of day right here. Previous low of day. And then now we need to mark the previous high of day up here, right? Notice how I'm marking this point right here and not this point because this is out of session. It has to be in session. So this is the okay, right here. This is the previous high of day. Sorry, let me delete this. Okay. this right here. Previous high there. I had a mental break, a mental fart right there. All right, so now that we have the highs and lows marked, we need to do a top-down analysis to identify where the market is actually going, right? Because we need to know where the market is pushing to. Price always pushes from supply and to demand, and demand to supply. So we need to find where we're coming from to where we're going to. So if we look left, we could identify where we're coming from. We're coming from this daily supply that created this huge push to the downside, right? So this previous contrary candle before the push that's not touched, that's your area of supply. You can see we touch it here to the exact, like pretty much the exact pip, and then now we're getting a pullback. That pullback is going to be to an area of demand that created the push. So if we break this down very detailed on H4, notice how this previous contrary candle right here that created the push, we have this void to fill. That's our true area of demand. These areas here are not valid because these areas are touched right here, right? So these areas are areas of interest, but this is the actual area that created the push. And if we notice, price is approaching our true area of demand. And if we go to the weekly, we could see that we have the weekly and the H4 in confluence, this previous contrary candle that created the push. So very likely we'll get a reaction off this area. If we don't get a reaction off this area, we have to keep in mind that price could keep pushing down. Nothing is stopping price then till this next target right here, which would be this daily demand that created the push, this right here. So if we break this area of demand, literally nothing is stopping price till this next target down here. Now, if we start pushing up, then we got to identify possible areas of the supply that we could push up to. But we got to take it one step at a time. We got to see where the market is going to next before we could identify the next 3 steps, right? So we just identified where the market is going to next, which is this H4 demand. If we break it, then we know that we're going to this next target down here. We just pretty much just broke down the next few steps for price. Now, we need to go to a lower time frame to see what we're actually working with. So if we go to M15, check this out. This is where the sauce comes in, guys. So pay attention. So now we just identified our target down here, right? So now we just need an entry to take us to this target. So if we break this down, notice on M15 right here, we create this area of supply, right? This is sauce. I promise you guys, pay attention right here. So we create this area of supply right here on M15 that creates this push. Notice how we pull back into it, like pretty much right here, London pulls back into this area, we get this push. But this is the sauce right here. When I come to sit down, I notice this, that we reacted off this area, we got this push. But more importantly than that, we created this new area right here on M5 that we got this other push. So I want you guys to pause your screen and just look at this right here. Notice where the volume is coming from. The volume is coming from this area of supply. Volume is coming from this area of supply. Literally, this is what's pushing price. This is just pulling back to push price, right? So what could we identify? That where price is literally selling and we have our target down here. So all we got to do is identify that pre-New York set us up already. Pre-New York created this M15 supply right here in confluence. So let me mark this as M15 right here so you guys can see it. M15 in confluence with the M5, right? Also, if we go down to M1, we have the M1 right here. So when I have these time frame confluences right there, I just place my sell limit because I have these time frame confluences right here, right? This is the area that created this push. This is the high probability to take the sell from. Now, watch, check this out. Let's fast forward this right here. And the reason I'm actually doing this trade breakdown is because, like I said, I have someone that, I know someone that sold from this another area that I'm gonna mention that's a low probability area versus the high probability area which we took, and I know it can make a difference for you guys. So check this out. For example, right, how I said this is literally what I just did with the stick figures at the beginning of this video. So the previous session creates the push, and then your session creates a new push. This area here is a low probability area to take a sell from. This is low probability. We don't want to take a sell from here because the push came from right here and we have this void to fill, right? So what did I tell you guys? Price will use these areas just to get a reaction, to find demand, to then continue to push to the true area of supply to give the move, something like this, right? So we'll use this as a reaction and then we'll push off the true area of supply that created the push. So this is the difference between a low and a high probability trade, and you guys are seeing it here live breakdown, and this is actually a trade that I took in the market. So you guys are seeing this area is low probability because the push came from this area. This is just going to be used as a pullback. So if we fast forward, we actually place our sell limit right here, literally right here. And I had a 10 pip stop loss just to cover a little bit more of this area here. So it looks something like this. And then notice exactly what I tell you guys, that this right here, pretty much this, the trade looks something like this, something like that. But you guys can see that this area here, exactly what I mentioned, price just uses as a pullback to find demand, to actually find the true area supply. And then notice the volume from the session comes from where we enter from. So check that out. Literally, this plays out perfect. Notice how we catch the move. This, what I first highlighted from New York, this is a low probability setup. You want the high probability setup is where the volume comes in from. So I hope this video can help a lot of you guys. I dropped some heat for you guys. Leave a like, comment, subscribe, and I'll see you guys in the next one. Peace.